Welcome to Sustainability Bridges, a Eurosif podcast that aims to build bridges between policymakers, investors, academics and civil society around the theme of sustainable investment. Eurosif, the European Sustainable Investment Forum, is the leading pan-European association promoting sustainable finance and investment at the European level. In these podcasts, Eurosif's Executive Director invites distinguished guests for a 30-minute conversation on current events shaping the sustainable investment community.
Hello everyone, my name is Pierre Garrault and I am a Senior Policy Advisor at Eurosif, the European Sustainable Investment Forum. For this episode of Sustainability Bridges, I am honored to be joined by Mr. Dan Dionisie, Head of Unit for Company Law within Diligence of the European Commission. Dan was previously Head of Unit for Economic Analysis and Evaluation, as well as Head of Unit for Consumer Markets, both also within DG Just. Before that, Dan spent more than 10 years working for the United Nations Development Programme in various roles aimed at public administration reform and anti-corruption. Together, we are going to discuss the Corporate Sustainability Due Diligence Directive, CSDDD, and its purpose, as well as its final provisions and what this will mean for companies and investors. So Dan, many thanks for joining us today. First of all, so for our listeners who may be a bit unfamiliar with this file, could you briefly tell us about the Corporate Sustainability Due Diligence Directive, its purpose, and its main provisions?
Good morning, Pierre, and thanks for inviting me to this podcast. So yes, the CSDDD, as you called it, fundamentally aims at aligning our economic model to our societal values, in particular with regard to the respect for human rights and the protection of the environment. And it is doing that by engaging the business sector in the sustainability transition. Concretely, it provides what we think is a balanced and effective legal framework for large companies to identify, prevent, mitigate, and bring to an end adverse impacts on human rights and the environment in their own operations, those of their subsidiaries, as well as those of their business partners in their value chains. The directive also sets out an obligation for the same large companies of all sectors to adopt and put into effect, through best efforts, a transition plan for climate change mitigation. The enforcement regime for the directive consists of a combination of public enforcement, so that includes administrative penalties, for instance, as well as civil liability, together with measures to facilitate access to justice for victims, both in the EU and outside the EU. So again, the directive covers the value chains of large companies wherever they are, so across the world. The CSDDD is designed to foster continuous engagement with value chain partners as opposed to disengagement, which is only an option of last resort when no measure of due diligence can improve the situation. It contains provisions also to facilitate compliance and limit the burden on companies, in particular safeguards for SMEs where they are indirectly impacted as business partners in the value chain of large companies. And business operators will be also supported through a variety of measures, from guidelines to model contracts to accompanying measures such as information platforms, a single help desk, financing for SMEs, and other types of support. This also includes accompanying measures directed at business partners in third countries, so in non-EU countries. This would be it in a nutshell in terms of what the CSDD or CSDDD represents and its main features.
Many thanks, Dan, for this very comprehensive overview. So today we'll focus on some specific aspects of this file, and you mentioned that it would apply only to the largest companies. And you also mentioned that this text will apply all across their value chains. So on both these points, there were some discussions on the size threshold for companies under scope and the extent to which their value chain would be included in due diligence requirements. Could you quickly summarize in detail the final CSDDD requirements on both these aspects?
Right. Okay, concerning, so we refer to these two aspects as personal scope and material scope. So personal scope meaning which companies are covered, falling directly into the scope of the directive. And here we're talking about EU companies with more than 1,000 employees and a net turnover worldwide of over 450 million euro in any sector, whatever the sector they operate in. So this is these are the thresholds in terms of employees, so 1,000, and the net turnover 450 million for EU companies. We also include in the scope those companies that by themselves do not reach these thresholds, but are the ultimate parent companies of corporate groups that reach the thresholds on a consolidated basis. So this is a measure introduced by the co-legislators simply to cover in an equal way all possible corporate structures, and with the same intention to let's say cover the different business models. Also, franchisors and licensors may be included in the scope under very specific conditions, and there are special thresholds provided for them. So in total, this makes approximately 6,000 companies in the EU. Again, the largest companies. These would fall directly within the scope. They will be subject to this due diligence duties and what I explained before, also the duty to adopt a climate transition plan. They'll be subject to administrative enforcement and to civil liability under the directive. Now, the directive also covers non-EU companies that have a significant business in the single market. And it's normal to do that for reasons of ensuring a level playing field and not, let's say, put our companies at a disadvantage. So we also regulate non-EU companies that have significant presence here. And for them, the thresholds refer only to the turnover, but not the worldwide turnover, as in the case of EU companies, but the turnover that they have in the EU. So we cover companies from non-EU countries that have at least 450 million net turnover in the EU, again, in any sector. And also parent companies of corporate groups under the same conditions, so that individually do not meet the thresholds, but do this as a group on a consolidated basis, as well as franchisors and licensors under very specific conditions. So in total, we estimate around 900 non-EU companies to fall within scope. Again, so around 6,000 EU companies and around 900 non-EU companies. So this is about the personal scope. Now, your question about the material scope, or rather what we mean by value chains and what's the coverage of this directive. Indeed, here we have to get a bit into the specifics. The co-legislators actually did not use the term value chain as was initially proposed in the Commission's version, in the Commission proposal, but what is now called chain of activities. And here, basically, we have two parts, this so-called upstream and the downstream. So the upstream chain of activities is defined as activities of a company's business partners related to the production of goods or the provision of services by that company, including the design, extraction, sourcing, manufacture, transport, storage and supply of raw materials, products or parts of products, and the development of the product or the service. So this basically means that the coverage of upstream is really comprehensive. So all the upstream value chain falls within this definition. When it comes to downstream, however, the definition in the final form of the directive as adopted is a bit more limited. So it refers to the activities of companies, business partners related to the distribution, transport, and storage of a product of that company, where the business partners carry out those activities for the company or on behalf of the company. So this basically means that in the downstream part, we cover these activities of distribution, transport, and storage when they are carried out by so-called tier one business partners, so mainly direct contractors or somehow undertaking these activities on behalf of the company. So this would be the, let's say, material scope in terms of the chain of activities.
Thank you, Dan. So still a comprehensive coverage also with regards to the value chain. So we mentioned companies that would be directly affected by those requirements, but of course, within those different value chains, there are a lot of other business partners, as you mentioned, that will be affected. And there were also a lot of questions raised on the impact of these rules on SMEs, forming part of this value chain. So could you also elaborate on the provision of CSDDD to address concerns on SME reporting?
Thank you for the question. Indeed, there has been some concern expressed with regard to the impact on business partners in the value chains and in particular SMEs. And just to be clear, this would be an indirect impact. So the SMEs are not in the scope of application of the directive. So they are not subject to legal obligations or to civil liability or to administrative enforcement. But of course, we acknowledge that they may be there will be an indirect impact on them when they are part of the value chains of the large companies within scope. So with this in mind, the directive, as agreed by the co-legislators, contains a series of provisions that ensure that these business partners are supported where needed, but also protected from, let's say, unnecessary burden or burden shifting from the large companies to them. And I would mention just some examples of these provisions. Some of them apply in general to the business partners in the value chains, and in some cases they are directly targeted at SMEs. So first of all, I would say one measure is the type of the due diligence duties, the very nature of the due diligence duty, which is risk-based. So the directive emphasizes this risk-based approach to due diligence. And this requires, for instance, the companies in scope to take into account the relevant risk factors. So this includes, for instance, geographic or contextual risk factors. And why is this important? Because this means that the large companies will focus their due diligence efforts where the impacts, the adverse impacts on human rights and the environment are most likely to occur, and they will also prioritize the high risk areas. And this makes that, where SMEs or other business partners in the value chain are low risk for a number of reasons. For instance, that, for they are in the EU or in other jurisdictions that have strong standards on human rights and the environment and well enforced standards in these areas, they are not likely to make the subject of intensive requests or due diligence actions from the large companies. So this risk-based approach in itself focuses the efforts where it really matters. Then there is, for instance, a provision to prioritize information requests, again, based on where the adverse impacts are most likely to occur. So this means, for instance, that the large companies should not burden their business partners with information requests where it's not really necessary. They can actually go directly to that level in their value chain where the impacts are occurring. Why is this important? Because we have seen, for instance, the example and the problems raised by the German due diligence law, which has been into application, where really the focus by law is on tier one business partners. And this means that a lot of information requests go to tier one business partners of German companies. And these are, usually EU-based companies or SMEs in many cases, because not to forget, almost 99% of companies in the EU are SMEs. And, they are burdened with this request for information when in fact, they are not really high risks. So therefore, this prioritization of information requests also helps relieving the burden on SMEs, and in particular where they are low risk. Then the large companies within scope are also required to adapt their purchasing practices, and this with the view to prevent or address negative impacts. There are provisions related, for instance, to the living wage or living income. But this can also be very beneficial to SME business partners because purchasing practices include, for instance, delivery times, payment terms, and price negotiations. And we will also the Commission will issue guidelines on how to adapt purchasing practices. Also, there are specific provisions for supporting SMEs. For instance, as part of their due diligence, the companies in scope are required to provide targeted and proportionate support to their SME business partners, including financial support where necessary. And they are also required to make investments in their value chain as necessary, which also can be beneficial to business partners in the value chain. I mentioned that there are safeguards against burden shifting through contracts, for instance, and because part of due diligence will be to seek contractual assurances. But when such assurances are obtained from an SME business partners, the terms must be fair, reasonable, and non-discriminatory. And the Commission will adopt guidance on model contract clauses to facilitate a clear allocation of tasks between the contracting parties and ongoing cooperation in a way that again avoids imposing unnecessary burdens on business partners for the provision of information or burden shifting in terms of the compliance, the due diligence duty to a business partners. Also, when when third-party verification is used, because that's also one of the tools of due diligence, the costs for such third-party verification will have to be borne by the large company in scope, so the one that has the duty for due diligence. At the same time, if the SME wants to take part in this to cover part of the costs, they have this possibility, and then that will give them the possibility to use the verification report in relation with other business partners, with other buyers, for instance. And also, I mentioned earlier accompanying measures. Many of these will be targeted at supporting the SMEs. There will be information and support provided through dedicated websites, platforms, or portals by member states with specific consideration for SMEs. There is a possibility for member states to provide financial support to SMEs. And also the Commission may complement the support measures from the member states. So all in all, I would say, there is a lot in the directive that aims at supporting and protecting the SMEs and in general the business partners in the value chains of large companies. And looking really at everything that's out there in terms of due diligence legislation, we can safely say that the CSDDD is by far the most SME-friendly due diligence legislation, and also in general the most business-friendly, because it does include facilitation measures also for the companies within scope to, let's say, to keep their compliance burden at a minimum.
Thanks, Dan. So yeah, a risk-based framework that really focuses on also protecting and supporting companies that are indirectly affected by its requirements. So we mentioned the due diligence requirements of the CSDDD, but there is also another important leg to this text, which is the adoption and putting into effect of transition plans with climate targets, which companies in scope will need to report in line with the Corporate Sustainability Reporting Directive, CSRD. Could you quickly also elaborate on these requirements, what they are expected to improve also in the economy and for companies under scope?
Yes, indeed, the company's reporting climate transition plan under the Corporate Sustainability Reporting Directive and the European Sustainability Reporting Standards adopted under that directive are considered to have complied with the CSDDD obligation to adopt such a plan. So if they report a plan we consider under CSRD, we consider that they met the obligation to adopt such a plan in the CSDDD. If a company falls under the scope of both CSRD and CSDDD and doesn't have a climate plan, because to remind you, under CSRD, there is no obligation to have a plan. There is an obligation to report it if the company has such a plan. So if when a company falls in the scope of both directives and doesn't have a climate transition plan, it will have to adopt one as an obligation under the CSDDD. And then, of course, because it has a plan, it will have an obligation to report it under the CSRD. So this is, in a nutshell, the interplay between the two directives. But I would say that in addition to the obligation to adopt a climate transition plan, what's also very important with the CSDDD is that it requires the companies to put into effect the plan, meaning to implement it. And this aims to ensure through best efforts that the business model and strategy of the company are compatible with the transition to a sustainable economy and with the limiting of global warming to 1.5 degrees Celsius, in line with the Paris Agreement, and also with the objective of climate neutrality, the net zero regulation, including the intermediate targets, so net zero by 2050, but also intermediate targets starting with 2030 and every 5 years. And where relevant, also the exposure of the company to fossil fuel related activities, coal, oil, and gas. And it should also be stressed that this climate transition plan covers all emissions. So scope 1, scope 2, and scope 3 emissions. This is very important. So I would say what's important to retain is that indeed there is this interplay between CSDDD and CSRD, in particular when it comes to reporting. So reporting is covered by the CSRD, but the CSDD is not just about reporting, it's about implementing the plan. And this, of course, is an obligation. It's framed as an obligation of means through best efforts, rather than an obligation of results. But still, we expect it to lead to meaningful action for climate change mitigation across the value chain of large businesses. Again, scope 1, scope 2, and scope 3 emissions are covered. And this is important because it's indispensable that the business sector play its role in addressing the climate urgency. Otherwise, obviously, we will not be able to make a difference.
So you mentioned some transition plan related requirements in CSDDD that are in line with the CSRD requirement to disclose transition plans when stakeholders have transition plans to disclose. How does the European Commission intend to coordinate the different requirements surrounding transition plan and ensure there is a single understanding of what a credible transition plan should be across EU regulations?
Yes, thanks for the question. And let me reiterate that, as explained, there is no duplication, because reporting a transition plan under CSRD means being in compliance with the obligation to adopt such a plan under CSDDD. In addition, the CSDDD requires the companies to implement the plan, put it into effect, as explained, and also update it annually, including on progress towards targets. So this is mentioned in the third paragraph of Article 22. What is important, of course, so we're talking, there's no duplication. We're talking about the same plan, certainly not two different plans. What's important going forward is indeed when it comes to the practical aspects and the guidance that will be issued. The Commission under the CSDDD is expected to issue practical guidance on the transition plan. And for this, of course, we will make sure that there is very close alignment and full coherence with the reporting standards, the ESRS developed under CSRD. And in particular, this may be relevant when it comes to sector-specific aspects. So going forward, our focus will be that this guidance on the transition plan that we have to issue under CSDDD will be consistent and aligned with the European sustainability reporting standards under CSRD. But this is the focus of our work in the coming couple of years. These sets of guidelines and accompanying measures for the CSDDD.
Completely agree. And we know that this is also a general effort all across the European Commission, because we are talking about transition plans under CSDDD, CSRD, but there are also some work done by the European supervisory authorities on transition plans that would be applicable specifically to banking and insurance in particular.
Indeed. And yes, there is also a deliberate effort to ensure streamlining and avoid any duplication when it comes to these duties, but in particular when it comes to reporting, but also everything related to the climate transition plans. And this is led from the central level in the Commission by central services. Is also part of this pledge that was made by our president to reduce the reporting burden on companies. And we are fully committed to do our part. So by ensuring that the CSDDD does not add burden and is fully uses and is aligned with the reporting provisions already present in the CSRD and in the ESRS, the reporting standards.
So now focusing on specific actors, we mentioned companies in general, but financial institutions are also under scope of the CSDDD. Can you tell us what is exactly expected of them as, under scope of the CSDDD? What does it mean for them, and how can they already prepare to apply the provisions that apply specifically for them?
So I've seen some comments in the public domain saying that the financial institutions are excluded or not covered by the CSDDD. It's not exactly like that. I would reframe it a bit. So the financial undertakings are included in the scope of the directive, just as the other sectors. So they are not there. There's no carve out for finance. The obligation established in the directive fully apply to them, including the due diligence duty and the duty to adopt and put into effect the climate transition plan, which again, as I mentioned earlier, also covers scope 3 greenhouse gas emissions. So in their value chains, meaning also they have to look at their clients in terms of the climate transition plan. However, where indeed the coverage of the financial sector, let's say, is incomplete, is when it comes to the downstream value chain, because the way in which the downstream chain of activities is defined in the directive does not cover the client relationships of financial services. I remind you, I mentioned earlier when discussing the material scope, that the way the downstream chain of activities is defined focuses on activities such as transport, storage, distribution. These clearly do not cover really the nature of the relationship of financial services with their clients, being investment, loans, insurance, or other types of financial services. And that is an issue because obviously this is where the financial services produce their main impacts. So in terms of sustainability, the impact of the sustainability impact of a bank is not so much, where it procures its printing paper or computers, but really where it gives credits, what type of activities it finances. So indeed, with this in view, there is a provision in the directive that says that this issue, the coverage of the client relationships of financial services, will be reassessed under a specific clause 2 years after the directive's entry into force, so meaning in 2026.
Yes, and at Eurosif specifically, we were pretty supporting the fact that the financial institutions would be included in the downstream value chain. As for investors, this is also expected to have positive impacts, clarifying the framework for their engagements in their invested strategies in preventing and mitigating adverse impacts of their investments. So you mentioned also the inclusion of downstream value chain due diligence for financial institutions, which will be subject to a review clause in 2 years' time. Could you elaborate on this and explain what are the next step and what will be the process for the European Commission to assess the relevance of this extension?
Okay, for us, this is a pretty standard process that applies whenever carrying out an impact assessment and preparing a legislative proposal. The challenge, of course, is that the timeline is very tight. So considering our usual cycles, and in particular, the better regulation steps linked to the impact assessment, some parts of which are really incompressible, you cannot shorten them. This 2 year for coming up with this report that includes an impact assessment and possibly a legislative proposal is really very tight timeline. So we have started already to collect evidence for this purpose. And we know we will not have enough time to commission a study, to contract a study, as sometimes we do, to collect data from the ground. Here we will have mainly to rely on what's already available, the information that we can get from the stakeholders or that is in the public domain already. The good news is that there is quite a lot. So there is information on finance and its impact in terms of human rights and the environment, and on sustainability efforts in the area of financial services. There is research on this. So we will try to gather all this information. We will also use an open public consultation and call for evidence that will be launched later this year in autumn, to make sure that we're not missing anything important that's out there. And then we will basically have to do the analysis in-house and to write this report 2 years, as well as the impact assessment and possibly the legislative proposal. So a challenging task ahead, one of the several, because we also have to issue a broad set of guidance on specific aspects of due diligence, as well as on the climate transition plans, also the accompanying measures that are provided under the directive. So this will certainly keep us busy in the coming months and for at least the next 2 years.
Mm. So yeah, a challenging timeline, and also I guess the need for potential industry participant to share their input with you on how it could be actually workable in practice. We know that there are international guidelines that do also apply, the OECD guidelines that already apply to some extent to financial institutions. So we know that to some extent it is workable. Now I think the
Exactly.
point. Mm.
Exactly. As I said, I mean, yes, the timeline is challenging, but we are not in a vacuum. There is already experience. There are front runners who have been doing due diligence under the existing voluntary frameworks, including, you mentioned, the OECD guidelines. So yes, we are not starting from scratch, but indeed we'll have to see what tailored due diligence requirements would apply to the specific financial services to really ensure that they are both workable in practice and impactful in terms of improving the situation, human rights and the environment.
So we discussed the timeline for this review that is expected to be challenging. There are also a more general component of a timeline in CSDDD, because it will be applicable gradually, phasing in, starting with the largest company under scope 3 years after entry into force, and for a full application that is expected in 5 years. So just more of a direct question is, what is actually expected once CSDDD is fully applied in terms of concrete impact? So you mentioned the expected positive outcome of this. What would be an ideal scenario in your opinion?
Well, clearly the CSDDD is aimed at making a real impact on the ground by ensuring respect for human rights and the environment, but also by opening the possibility, the path to remedies for victims of harm. What it is not about, it's not about creating more paperwork and box ticking. So it's very important to achieve this behavioral change from the large companies that fall within its scope, and an impact on the ground. And we know the adverse impacts actually tend to be quite far away in the value chain, so not necessarily in the own operations of the companies or their direct contractors, but can be farther away in the value chain. And we don't want to we want certainly to avoid this becoming a paper-based reporting and box ticking exercise. That's why it doesn't come with new reporting requirements, but with behavioral obligations and with civil liability. I also realize, and we all, with the colleagues, we realize that the actual impact will crucially depend on how it is implemented. And this is why what I mentioned earlier, the work ahead on the guidelines, on the accompanying measures is really essential. The work with the member states as well on the transposition of the directive in their national legislation. So this is really crucial to ensure that the directive is effectively implemented and achieves its objectives, which are to advance towards a sustainable way of doing business in Europe and eventually globally as well.
I think throughout our discussions, we realized that a lot of the provisions of the CSDDD are also aiming at identifying risks, whether they are legal or management or reputational, all across the value chain. So I would guess that your message for companies that will have to apply CSDDD is also that it is potentially a good risk management tool.
Yes, absolutely. And not only that. Actually, we know that many companies, they say they are prepared for the CSDDD. For instance, we've seen a recent poll of German companies, a survey, where most of them were saying that they are prepared. And many have already taken action on human rights and the environment in their value chains under the existing voluntary frameworks. There are the UN guiding principles, the OECD guidelines, and some of them have also already been subject to mandatory legislation, because we know some member states adopted such legislation, Germany, France, and therefore they are relatively familiar with what is expected from them under the CSDDD. And that's why many companies, as well as business associations, and including SME associations, have been supportive of the CSDDD. It brings opportunities. You mentioned better risk management, brings also a more level playing field. It really stimulates competitiveness and innovation in the companies. So I would have, let's say, two messages to the companies that will fall in the scope of the CSDDD. First, to really see it as an opportunity, as an investment in their sustainability transition, in their future. There is ample evidence, there are thousands of studies that show that embracing sustainability makes business sense. So it's good for business as well. It improves resilience, innovation, competitiveness. And as I said, the key contribution of the CSDDD will be to also avoid regulatory fragmentation in the single market through, let's say, various requirements by legislation in different jurisdictions. Second, I would emphasize what I said earlier, that the CSDDD is by far friendly and the most SME-friendly due diligence legislation adopted so far. I enumerated the supporting provisions and safeguards for SMEs and, let's say, value chain business partners, but also there are such measures even for companies within scope to facilitate implementation, and there will be accompanying measures and guidelines to further support them. So the message would be really embrace this as an opportunity. It's an investment in the future, and it will bring good things, let's say, for companies. And also take note that it includes many facilitations as safeguards, and it's really as business friendly and as SME friendly as any due diligence legislation out there.
And it is especially relevant when we link that to the climate transition plan's requirements under CSDDD as well. So as we know, forward-looking metrics are among the most requested for investors. So establishing and implementing a climate transition plan will also be a way for companies to unlock financing, especially currently in the discussions surrounding revitalizing the capital markets union. So let's maybe now take a step back from CSDDD and its implementation and its potential review, as we just mentioned. So we just entered a new European mandate, and there will be a lot of work also for Digijust in the coming months and years. Could you maybe share with us what are the potential future areas of work in the coming years, for example, with regards to the Shareholders Rights Directive?
Yes, I mean, for us, the future mandate will be to a significant extent about implementation. So when it comes to CSDDD, I mentioned there is a lot of work on implementation, but also we are in the advanced process of adoption of another important directive on upgrading digital company law, which will also include significant implementation work, will involve significant implementation work in terms of follow-up. And there will also be some legislative action, probably. So in addition to the review clause on financial services under the CSDDD, you mentioned the Shareholder Rights Directive. And indeed, I can confirm that we are looking at the possible revision of this directive in the next mandate. And some preparatory work for this has been ongoing already. For instance, we have a study running that should be completed by the end of this year, which is a partial evaluation study, mainly covering issues related to the chain of intermediation, proxy advisors, market standardization. So this is close to finalization and will inform any future revision of the Shareholder Rights Directive. At the same time, it's also important to note that the possible revision of the Shareholder Rights Directive, especially when it comes to shareholder engagement, which is a key focus in the second Shareholder Rights Directive, such a revision has close interlinkages with the 2-year review clause on financial services under the CSDDD, because the CSDDD may set up due diligence obligations for investors, and the Shareholder Rights Directive also covers shareholder engagement. So this is why we have to take into account these interlinkages and soon into the next mandate make some decisions on the basis of these interlinkages and of the information, the ongoing study about, let's say, the scope and the sequencing of the revision of the Shareholder Rights Directive. So you should hear more from us in the coming couple of months about the precise timeline. But indeed, it's certainly on our to-do list for the next mandate.
And indeed, engagement is particularly important for investors. It's one of the key tools for them to actually contribute to the transition of their investing companies as well. And so you mentioned interlinkages. There will be, I think, an important one with the potential upcoming review of the SFDR as well, the Sustainable Finance Disclosure Regulation, where there are talks of creating a transition investments category, and where engagement could have an important role there.
Exactly. So indeed, there are several pieces of the puzzle. I mentioned the ones, let's say, that are directly in our portfolio. And as emphasized also earlier during this discussion, it's very important to ensure that all these processes are coherent and streamlined. But that's why I'm saying we should look closely at the timeline and the scope of legislative action into the next mandate.
Thank you very much, Dan, for joining us today and for this very interesting and insightful conversation.
Thank you for having me. It's been a pleasure.